Hi, I'm Ann. I'm with Global View Investment Advisors. I'm here with one of our financial advisors, Matt Crider. So if you're anything in the market, you understand that there's always a roller coaster of emotion and that you're always told never sell when there's a downturn. You hear stay the course, it will come back. You only lose whenever you sell, and yet we countlessly see over time that there's instances where people are still losing out and you're still underperforming. Can you touch on a little bit as to why that is? Why are we seeing that trend?
The average investor that's with their firm, not just with their firm, but in the general market populace, underperforms their actual investments that they're holding. I actually believe there's two reasons why investors experience this disconnect between performance of their investments and their individual circumstances, their individual investor performance. One would be fundamentals. So, and this is what we're going to talk about here, is just understanding the fundamentals of what it is to invest when things are scary. But also there's behavioral components as well, which we'll have another conversation about at a later time. So I'm going to give you three areas here just around the fundamentals that you might be overlooking when things get really scary in your investments. Number one is that losses are part of the growth process. Specifically, disruption creates opportunity for investors. When things are just euphoria and nothing can go wrong, that's actually the point of maximum risk, because nobody is thinking about what can go wrong. But the complete opposite is true as well. When things are, at the bottom and you can't really see how things are going to get better, that's generally and has historically shown to be the point of maximum opportunity. Number two would be understanding and not conflating that temporary loss is the same as permanent loss. Temporary losses are going to be reflected in those market cycles. But permanent losses are going to be actual permanent loss of capital, and it depends on the types of companies you're investing in, the quality of the company. It's not about being right or wrong. You're almost certainly guaranteed to be wrong a lot of times when you're investing, but it's limiting the severity of your wrongs so that your wins don't have to work as hard to make you money. Third is that investing is, in and of itself, a time arbitrage. What does that mean? Well, what do you do when you buy a stock? What are you actually doing or hoping to achieve? Well, you're just hoping to participate as a shareholder, as a partial owner of that company. You're hoping to participate in future earnings and growth of that company. When you know that a company has a strong outlook, a strong balance sheet, or a very strong management team, and for some reason there's a short-term disruption that's causing them to underperform, well, that creates a discount. And if you can pay a discount for that stream of earnings into the future, you've made money just on the purchase. The key is patience, and that's the time arbitrage. Is you have to allow time to pass to reflect the good decision you made and not abandon the decision you made. Just a quick note about everything that I've said and kind of the assumptions is that this is not an own everything and hope it works out approach. You have to know what you own and why you own it. It's also assuming that you're doing the due diligence and that you're intentionally buying the quality assets that will survive scary markets in the time, or scary times in the market rather. And if you think you're working with somebody or you just don't know what you own and why you own it, and you want to have a firmer grasp on how you should be investing, then I would invite you to come talk to us and let us help you out and explain further and educate you on time-tested processes.